Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing NAKD stock by analyzing its financial ratios and dissecting its financial statements to determine if it's a buy or a sell. NAKD is an intimate apparel and swimwear company. It designs, manufactures, and markets a portfolio of 9 company-owned and licensed brands. Fredericks of Hollywood is one of the company's brands. Let's get started with the model. This is a micro-cap company, 234 million market cap. They're trading at 21 cents a share, and they have 49 million shares outstanding. Let's look at the financials. The way you value a company, you estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And this company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also have negative net income every year. Their revenue is fairly steady. It does grow a lot from 2017 to 2018, but then drops the following 2 years. This is the company's income statement. The top line is the revenue. Below that is cost of revenue. So they do have positive gross profit each year, but their operating expenses are above their gross profit, so they have negative operating income. So before they pay any interest or taxes, they're losing money. And of course they have interest on their debt, and then they lose money on other income, and then they have taxes. So they have negative net income every single year, and it gets worse each year. The company has 7 segments: the Australia retail, New Zealand retail, which are 2 of the bigger segments. Their biggest segment, however, is e-commerce. That was 31 million. And these numbers are in New Zealand dollars. I converted all their financials to US dollars on my Excel spreadsheet. So it's such a big operation, although they have a good amount of revenue coming in, they have so much expenses, it eats away at all the revenue. This is a statement of cash flows. On the top is the operating cash flow. And I always like to look at operating cash flow because it's a better indicator of a company's financial health than net income. And you can see they're operating at a loss each year, so they need to take on debt or equity just to fund their business. And the way you calculate free cash flow is operating cash flow minus capital expenditures. So each year they have negative free cash flow. So you can see this company issued 5 million of debt in 2018 and 21 million in 2020. But they pay back a lot more in debt, 10 million, 18 million, and 10 million. Because when debt is due, you have to pay it or you're forced into default. They're also diluting their company by issuing capital stock, 22 million in 2018, 23 million in 2019, and 12.5 million in 2020. On a long-term basis, you can't fund your business on equity and debt because at some point it's going to run out. Let's look at a capital structure. $45 million of debt, negative $4 million of equity. When a company has negative equity, that means the liabilities are greater than the assets on the balance sheet. They pay 8% of interest on their debt, and they're 100% debt since they have negative equity, and their WACC is 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's negative $3 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of negative $18 million. We divide that by 234 million shares. And we get a stock price of 0 because you can't have a negative stock price. They're trading at 21 cents, so it is a sell according to the model. Simply Wall Street does not have a valuation for this company. Simply Wall Street gets its valuation from the average analyst estimate, and analysts aren't valuing this company. So this is the stock price the last 5 years. So if someone looked at this chart, they would think, wow, the stock price was $500-600. So it must be a great value because it's only trading at 21 cents. So I'll buy it because maybe it'll go back up to $500-600. But the stock price was never this high. They did a 1-for-100 reverse stock split in 2019. You would have to divide these numbers by 100 to get the real value. So it was trading at its peak about $5-6. But in order to stay listed on the New York Stock Exchange, they had to be above $1 a share, so they did a 1-for-100 reverse stock split. Even after they did the 1-for-100 reverse stock split and brought it back up to over $1, the stock prices come back down to 21 cents. And this article mentions the 1-for-100 reverse stock split. And it says here, today it looks like all that reverse stock split was good for was giving bears the ability to short the shares at a higher price. It says now, despite the reverse split, the shares are once again trading below $1. This article was back in January, I believe, so the shares were 95 cents then. Now they're much lower. If you invested $10,000 when this company IPO'd in 2012, you'd have $15 today, almost a 100% loss. The company mentions due to COVID, they had to close their brick and mortar locations. The company is working with its suppliers to see if it can delay the payments it's supposed to make. It's trying to get support from landlords for rent abatements. Its employees agreed to work reduced hours, and it's trying to get subsidies from the government in New Zealand and Australia. It is working with the banks to defer payments. I usually don't have a negative valuation when I look at a company, but based on this company's history, I just don't see how it could have positive cash flows in the future. If this was a startup, I would give them the benefit of the doubt, but since I know the history of the company, I just don't see what's going to change. Let's look at the financial ratios. The average PE is 14, the median is 14.5. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. The average price of sales is 6.0, the median is 2.2. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 0.8, so they're doing much better than the median and average. So you might say, wow, that's a great price to sales ratio. Maybe I'll invest in the company. But if you cannot convert those sales to profits, what does it matter? The average price to book is 4.6, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They have negative equity, so they have negative price to book. Equity is assets minus liabilities on the balance sheet. The average interest coverage ratio is 12.1, the median is 3.8. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. EBIT is earnings before interest and taxes. The average ROE is 11%, the median is 11%. ROE is net income over equity. They have negative net income and negative equity, so we can't look at the ROE. The average current ratio is 1.9, the median is 1.3. Current ratio is current assets over current liabilities. They're at 0.6, so they cannot cover their current liabilities with their current assets. Their current assets are $3.8 million of cash, $3.1 million of receivables, and $23 million of inventory. Free cash flow in the trailing 12 months was negative $15 million. If next year is the same as this year, they're going to need $15 million from somewhere to run their business. So they need to deplete all their cash. They need to sell part of their inventory. It doesn't look good for this company. The best way to look at ratios to compare them to similar companies, I've done videos on Capri, Canada Goose, Hanes, and Levi, all in the same industry as NAKD. And if NAKD has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they're negative. They do have a better price of sales than the average. Negative price to book. They have the worst current ratio. We can't look at their ROE. They're 100% debt. They're the smallest company by far, and they don't pay a dividend. So to summarize, I have this company valued at nothing. Their ratios and financials look really terrible. So it looks like they're probably headed towards bankruptcy sooner rather than later. Thanks for watching. Let me know what you think. Give this video a like, subscribe, or comment below. If you'd like to get a custom valuation, just support the channel. You can become a member by clicking on the link in the description below. Thanks for watching.